Few companies have changed directions as quickly as Netflix. For years, Netflix actually encouraged password sharing. It even joked about it online. Sharing your account wasn't seen as abuse, it felt like part of the experience. That approach helped turn Netflix into a global giant, with more than 230 million subscribers at its peak. Then almost overnight, the company changed its stance. Millions of people who had been watching for free were suddenly asked to start paying. Because behind the scenes, one of the most important numbers in tech was starting to slow down: growth. Netflix is the largest subscription streaming platform in the world. Its business model is simple. Users pay a monthly fee, and in return, they get unlimited access to a huge library of content. That content is expensive though. By 2021, Netflix was spending more than $17 billion a year on movies and shows, while bringing in about $29 billion in revenue. Unlike traditional media companies, Netflix doesn't rely much on ads. Its entire model depends on subscriptions. That means one thing matters most: adding new users. And for over a decade, Netflix did exactly that. Its growth seemed unstoppable. Streaming was steadily replacing traditional cable television. Internet speeds were improving across the world, making it easier to watch high-quality videos without interruptions. And more people were shifting towards on-demand entertainment. Netflix made everything simple and affordable. For a low monthly price, entire households and often even friends or extended family could watch whatever they wanted. Password sharing wasn't just allowed, it helped the company grow. At the same time, Netflix had a big head start. While traditional media companies were still focused on selling cable bundles, Netflix was investing heavily into original content and expanding globally. By the late 2010s, it had become the default streaming platform for millions of people. But that momentum didn't last forever. In early 2022, Netflix reported something it hadn't seen in over 10 years. It lost subscribers. The market reacted immediately. The stock dropped more than 35% in a single day, wiping out tens of billions of value. At first, it looked like competition was the main issue. New platforms like Disney Plus and Amazon Prime Video were growing fast, pulling both viewers and content away. But the bigger issue is saturation. In places like North America, almost every household that wanted Netflix already had access to it, whether they were paying or not. Growth had slowed down, and then Netflix revealed a key number. More than 100 million households were using the service without paying. That changed everything. What used to be a smart growth tactic was now a source of lost revenue. At the same time, costs were rising, competition was getting tougher, and investors were pushing for profits. So Netflix made a shift. Instead of only focusing on growth, it started focusing on making more money from its existing users. The company introduced two major things. First, a lower price subscription plan with ads. Second, a global crackdown on password sharing. Users could still share accounts, but now it would cost extra. The reaction was fast and mostly negative. Social media filled with complaints. Some users even canceled their subscriptions. It looked like a risky move, but the results told a different story. In 2023, Netflix had more than 30 million new subscribers, one of the strongest years in its history. Many of those new users came from people who used to share passwords. Instead of losing viewers, Netflix turned free users into paying customers. Revenue climbed past $33 billion, margins improved, and the stock began to recover from its 2022 lows. In other words, the strategy worked. Not because people liked it, but because they accepted it. By that point, Netflix had become a big part of how people watch entertainment. It wasn't just a service, it was a habit. And that gave the company pricing power. The password sharing crackdowns show something important about modern tech companies. In the early stages, they focus on growth above anything else. They make the product easy to use and easy to access, even if it means losing some money. But eventually growth slows down. Markets become saturated. Happens, priorities change. Companies move from growing fast to making more money from what they already have. What helped Netflix succeed early on, flexibility and user-friendly policies, became less important than profitability. The surprising part is that password sharing wasn't just a problem. It was one of Netflix's biggest untapped opportunities. And once growth slowed, unlocking that value became necessary. In the end, Netflix didn't crack down because it wanted to. It did it because it had to. Because when growth slows down, the only lever left is monetization.